Well, welcome to Two Drunk Planets. I'm Felicity.
And I'm Amanda.
And we look forward to having you join us every week where we catch up
Right here on the couch.
Right here on the couch.
We talk finance. We dispel a few of those really weird things that come up on Facebook and socials. Let's talk about what gets our goat.
Mix it with a good cocktail.
Oh, that's the best bit. How would we be two drunk planners if we didn't do that?
So thanks again for joining us. And remember, there's no substitute for good advice. So make sure you hop online and find an advisor when you need one. But in the meantime, enjoy this week's episode. If you're drinking with us, we've got 2 shots of lemon juice. So lemon juice, Cointreau. So I feel almost in liqueur.
Melon liqueur, lemon juice, and ice.
Nice. Bit of shake.
Actually,
Perfectly paired with the Audis. Perms and fluorescent outfits. Well, enjoy. Cheers to another Friday afternoon on the couch with the cocktails and some very interesting financial discussions, I think, today.
Let's have a go.
Whoa. I do have a question of the day. Well, actually, there's just a lot of good questions, but it's going to be easy for us to fall into what gets on my goat really quickly, I think, is the problem.
Okay.
So, first question that I have is, I will contact our lawyer tomorrow, but I have a question about my inheritance. My husband's parents have recently passed away, and he has been left their superannuation as an inheritance. Will we have to pay tax on it? And before we give the right answer, let's go through a few of these, just so that we can have a bit of a discussion.
Well, just to give those listening a heads up, I think the answer being it depends.
It always depends, and we're not giving advice. So
We're not, but we can give you some facts around how this works. So what are some of the best intentioned readers and listeners and watchers?
So the first interesting answer is no, the super fund will sell everything out, and because it's a cash payment, it won't be taxed. So I think we can go,
You know what we need? A big red buzzer.
Can we?
No.
Okay.
We need to get one of those.
Okay, so let's go that. Yep, thanks for playing. That is incorrect. So the response to that is super inheritance doesn't actually even go to an estate. It can only get paid out directly to a dependent.
Okay, we've got a halfing writing here, don't we?
Halfy.
It can be paid to a state, but it also can be paid to a superannuation CSAT dependent.
Yes.
So it's like, you're on the right track, but you're not quite.
Yes, but the idea that it can only be paid to a dependent is incorrect. So
a lot of people don't have CSAT dependents.
Correct. So before we even keep going with the myriad of other incorrect answers on this, shall we define who you can actually leave your super to?
Regional under the CSAT.
Under the CSAT. So let's just go through who we can leave it through first.
Done.
So spouses, well, partners, they don't have to be a spouse. Children.
Including stepchildren and adopted children.
Yep. And people who are financially interdependent or dependent. That's it. You can't leave it.
And your estate.
And your estate. If it's not one of those, it doesn't matter that the super fund writes to you and says, thanks very much for your binding death nomination. When it comes to actually acting on it, they're not going to.
No.
So they're the people that we can. Now, let's not spoil the fun of telling everybody who we can and can't leave tax and untaxed components to.
You're getting tricky.
So
the other answers.
One is the trustee or the solicitor will handle it. You have no say.
I think we need the buzzer for that one too.
Yeah.
The trustee does handle it. That's correct. But you definitely get a say in where you want it to go.
Absolutely. And it's the trustee. Well, if it's the trustee of the super fund, then the trustee doesn't handle the estate. The trustee of a super fund does not handle the estate. The trustee of the super fund can only,
First and foremost, it doesn't form part of anyone's estate.
correct, unless you tell it to go to your will.
Exactly. So super's not part of the estate. And for most people, their home isn't if it's owned jointly as well. So two big items that don't even form part of your estate.
Yeah. So then there is, because super has a taxable and an untaxable component, you're going to get taxed at your marginal tax rate, less a 15% rebate.
Okay, they're on the right track. They're not quite thick. It depends on who the person is it's going to.
That's still wrong. It's actually still wrong. It's got nothing to do with your marginal tax rate.
I understand what they're trying to say, even though, it depends on the dependent. If it's your spouse, it doesn't matter. It's tax-free.
Yeah,
Dependent children, the components do not matter.
correct. So
what would an adult child who gets the money? Would you want to explain a little bit more about that? So this person isn't dependent on you. You've got adult children. Your spouse has passed. How would an adult child be taxed on the suit, Felicity?
well, it does depend if it's taxed or untaxed, firstly.
That's what I'm talking about. They're talking about the component. So
Yeah.
they're kind of getting.
Yeah, so there are two components within the super. So everything that went into super that you claimed a tax deduction on as a percentage of contributions are the taxed component. If you're an adult and you're not interdependent or dependent,
In fact,
then you're going to get 15% plus a Medicare levy on the component that is taxable.
and not your marginal tax.
It's got nothing to do with your marginal tax rate.
Someone asked a question, everybody piles on thinking they know, and it again highlights to me how scary the lack of financial literacy, and everybody's got an opinion, and it doesn't matter if it's right or not. They don't mind giving their advice.
Like the next one, yes, he will lose 30% in tax. Nobody gets taxed at 30%.
Well, the super fund's already been taxed at 15%
Correct.
on the way in. Suspect will have a penalty rate if their earnings are really high,
Yeah.
for the most part.
But then they also got the tax deduction for it along the way. So nobody gets taxed 30% on super on the way out as an inheritance. The next one, super is different to every other asset. 32% tax will be payable on super going to adult children.
Wow. Where'd that come from?
I don't know. Our super has a testamentary trust, which also the super doesn't have a testamentary trust. The super might go to the estate and then the estate has a testamentary trust. But again,
Child pension,
correct.
but it's not a testament.
It's not a testamentary trust
Established
through a will. But again, nobody gets taxed at 32%. So that one's really incorrect. This is why my super is left to my legal personal representative,
Someone's eye.
i.e. my estate, because then nobody will have to pay tax.
Never mind.
So we got halfway there
We did. It was so close.
and then we fell over. Okay. Then there's just the yes, heavily.
I'm sure someone's got their fingers in that pie.
So I think it's important just to step back and go through it properly in terms of who gets taxed, who doesn't get taxed, and which components get taxed in super. So if you have a look at your statement from your super fund, you'll find that there's two components. Part of it is a taxed component and part of it is an untaxed component. And the way that those get made up is how you put the contribution in. So if all you've ever done is got super through SGC contributions, it's going, your employer, it's going to be 100% taxed. So i.e. when it's gone in, we've essentially got a tax deduction for it because we didn't have to pay tax on the money before it went in. And then when the super got it, they paid 15% tax. Hence, it's a taxed component. Then there's an untaxed component. So anything that I didn't claim a deduction for on the way in, so a non-concessional contribution, it's untaxed. And so when it goes to anyone, that percentage of the super also doesn't have tax payable on it. So often for you and I, when we talk to somebody that is now able to have access to their super, they've met a condition of release, we'll do a recontribution strategy, which you probably really want to see a financial advisor about.
Absolutely.
So we'll take the money out and put it back in as a non-concessional and therefore change, yes, the untaxed element, and therefore decreases the amount of tax that's going to go to an adult child if that's who it's going to go to.
Which is really good for people who have high balances in their super fund and don't want their adult children to be stuck with big tax bills.
Yeah.
It's a great strategy.
Because when we're talking about 17% tax, like even if you have $300,000, you've got over $45,000 worth of tax that adult children will have to pay if they get that. So
it's not an area that it's easy for people to just pile in with an opinion. It's something that's actually legislated, and you need someone who knows what they're talking about.
Yeah.
To be able to help you with it.
Oh, can I then give you another one of my Facebook posts?
Yeah.
Saw a private financial advisor. It makes me feel like a PI, like I'm a private investigator. I don't actually know the difference.
Was off my door.
Yeah, I don't know the difference between a public financial advisor,
But wealth manager at a bank.
this is a private financial advisor.
Secret squirrel.
And he basically said, I don't have enough money to see a financial advisor, as government rules say he has to sign me up for a yearly subscription of $2,000 to $3,000 before he's able to give me financial advice. Now, I'm not even going to go into the rest, but suffice to say they need financial advice. So there's a very long post, which actually has quite a lot of information. So kudos to them. But anyway, before we even do that, let's tackle the
Government rules.
Government rules that say he has to give a yearly subscription. And can we just go
You've busted time.
for the red buzzer? We really do need a red buzzer. That could be quite fun. Like, I might just, for now, until we have a red buzzer,
I'm going to put one in.
I'm going to use a sound effect.
Good for you.
So can I say the first thing here is this is why financial advisors are seen as a joke. They're almost in the same category as car salespeople and real estate agents, which wouldn't upset me except there's 98 likes.
Again, lack of understanding.
Like, that just makes me sad
Yeah, true.
because the fact is and let's just say, firstly, they don't have to make you have a yearly subscription.
Absolutely.
Advisors are free to charge the way that they would like to charge.
There's no government.
Yep. So you, for example, do a lot more one-off advice than I do in my business, where we will not do one-off advice because we are very much a long-term relationship, going to be with you for...
But that's not a government mandate. That's a business choice.
Correct. And relationship choice, and that's just who I like dealing with.
I would love all my clients to be on an annual subscription and come back all the time. The truth is, not everybody needs that.
Yeah.
Some people do have a set and forget strategy. Some people do have a look, I probably only need you every 2 or 3 years unless something changes. So it doesn't have to be. Look, for most people, it is absolutely a worthwhile investment to pop back every year. Am I on track? What's changed? Can I look at my...
Even for us that says we have a yearly thing, you're not locked in for a second or third or fourth or 10th or 15th. No, it's an year. It's an annual agreement. And then at the end of the year, we say, this is what we need to look at over the next 12 months. Do you want to go again?
Yes, sir.
But they know at that point that 90% of the time, there's things to do, and so let's keep going on with this, and what would I do without you and all the rest of it. But it's not like I'm charging you a yearly subscription.
In 2 or 3 years and you see the amount of change in their life, you know what? You should have come back and seen me sooner.
Yes.
Is those situations as well.
Yeah, where you go, oh, God, I wish you'd told me about that.
Yeah. The financial year end is past now. I cannot get that capital gains tax bill down for you.
Yes.
Cannot do that recontribution. You've passed the date. We've, all those strategies that could have, would have, should have if you've been on the annual fee.
Yep.
But certainly no government legislation. And again, it's about finding the advisor that's right for you. If all those big questions you've got can be handled in a one-off, and I'll see you when I next need you.
And then nothing's ever going to change. This is massive. Like, they are massive, though. There's 64 and 59.
Okay, so pre-retirement, there's lots going on.
And at that age, so I look at that, and again, no advice.
You don't have enough
No,
money.
the advisors, no, he basically said, I don't have enough money to warrant seeing a financial advisor, as he has to sign them up for a yearly subscription of 2 to 3 years before he can give advice. I wonder whether it's a miscommunication from the advisor.
And often what a client hears versus what we say can be two different things as well.
Because I would see this, and let's face it, can you give personal advice for under $2,000? No.
I'd love to.
You can't. By the time you have to do...
That's because of the actual government rules.
Correct. And to give the advice, you have to know a lot. So these guys have equity in their home, superannuation, health problems, might have to retire early, looking at selling so that they can be mortgage-free.
Downsize a contribution.
Correct. Healthcare costs of $50,000 to $60,000 a year in retirement. There's a lot going on here. And because of the age difference as well. So one's 64 and one's 59.
Which is brilliant for contribution strategies too.
From a Centrelink point of view and things like that. So I look at that and go, if you came to see me for a new appointment as a new client, I would be saying, A, it's not going to cost you $2,000 to $3,000. It's going to cost you more. But B, you're going to probably need to be with me for a good 5 to 10 years, because we're going to have to do things. Well, the strategies are going to take time.
And as your health deteriorates and your needs change, what if one of you needs to enter aged care if you've already got health issues?
Yeah, there's just so much going on, and you can't even do it in 1 year. Because you have to.
And I'm very much with those where there's so much happening, I'm a bite-sized pieces kind of girl.
Oh, yes.
So instead of me handing you, 180 pages with a strategy that you're going to use as bonfire material because you don't understand it and it's too overwhelming.
Yeah.
Although, you know what? Out of all your needs, this one right now is the most important. Mm. And we actually have to do a couple of other strategies with that.
Yes.
So let's tackle that first.
Yep.
You know what? Have a breather. Once we get that done, then come back and see me, whether it's a year or 6 months or 3 months, then we'll tackle the next part.
That's right. So it's ongoing, proactive. There's going to be multiple steps from it. And I also wonder, with that health problem, and we are likely to need to retire early, there's a whole insurance question in there too.
Yeah, do you have a TPD claim?
A lot of those, they're both under 65. It's quite possible that they have income protection, TPD, trauma insurance maybe even, that needs to be looked at along the way. It's that, to me, I look at that and go, $2,000 to $3,000 is, I couldn't do it.
For a woman who, her husband is a lot older than her. She's Mrs. H number 3.
Yep.
And as she was planning to retire in the coming year, she had an accident on her push bike, broke her shoulder. She is a carer, had to retire early, had no idea that she still had income protection in a student fund that her employer was paying.
Yep.
Ended up getting her an extra $15,000 a year in compensation through the insurance payouts, in addition to because she was over 60, started pension so that she could replace her income.
Yep.
So, you talk about, is 2 or 3 grand too much of an investment? Compared to what?
Well, this is the thing
That you don't add.
Correct.
It's crazy crazy massive.
And I think $2,000 to $3,000 would be cheap, I think, for this kind of work. And like I say, it's up to the advisor. But it's not a government thing. And that's the thing. So call out to one of the other podcasts out there. So I listened to a podcast recently where Phil from Construct Wealth was on it. So it was from Captain FI. And he said he was talking to a financial planner who said you should never pay annual fees, that you should only pay per visit. And somebody's actually very nicely come back and said, actually, that's not really the case. It was Phil. And they've just started with him, thought he was awesome, but it's not actually an hourly rate. It's a one-off fee with no trailing commissions, and they get a year's support, and the fee was $6,600. That to me seems like the kind of fee I probably would have charged as well.
For the ongoing support.
And it is 1 year of support. It's not this one-off, here's a plan, let's hope you implement that correctly, because let's face it, if you don't, it could actually be worse. It's not a subscription, but I'm pretty sure Phil will go back at the end of a year and go, we have more work to do. Would you like to pay me for another year? The same as I would, and I'm thinking in this you would as well.
Absolutely. No, there's lots to work through there. And at that age, I actually had a client sack me because he was getting close to retirement and couldn't afford me. Equally more than
Ever.
So, yeah, it was really interesting. And people see value in it.
Yep. And that's what makes me sad. So, because the next one is WTF. Is the point of a financial advisor then, if someone has enough money, then they wouldn't need their advice. They just rip people off.
I'm going to drown my sorrows and mind jealous.
Because I actually find the people with a lot of money, we don't make as much difference to. Like, they actually have enough money. They have to do something really, like we have a client that has $120 million. Well,
they're going to make money whether you try or not.
They're fine.
You're probably going to turn deposit 4% and they're okay.
They are fine. It's actually the person that has 400, 600,
200,000.
200.
How do I make this last for 20 years?
Yep. How am I actually going to do? That's actually where we can make a real difference. I mean, like you say, with that income protection, somebody doesn't think that they have a claim and now they're getting an extra $15,000 a year. Do you really care about the $5,000 fee?
Money you would have had otherwise.
So, but then I got this one, and I know you're going to love it. So this is where I said,
everyone goes now.
Well,
we're totally on the get.
Well, that's why I said this could get into the get my goat. Centrelink has great financial planners that could help you with this.
They have financial information service officers, and you'd love getting into one. But they are great.
They are.
I think financial advice.
Because then there's the next one. You don't need a financial planner. You need to talk to a Centrelink advisor. They give really good financial advice. They are not licensed to give financial advice.
These people aren't eligible for Centrelink.
Well, they're actually not, because they're 59 and 64. Oh, they might get a carers or a job seeker, but they're not getting an age pension. So what's Centrelink going to do about telling them whether or not they should sell their house, put money into super as a downsizer contribution? Well, no downsizer contribution.
Tell you how to get the best Centrelink outcome. They give factual information that may or may not be relevant to your circumstances, and it's not going to get you the best deal.
And this is why it turned into not what gets my goat, because it's not just the Centrelink one. But here is the next one. Your best option is to downsize before one of you retires so that you can make a downsizer contribution to your super fund.
Well, that might be all right.
What age can you make a downsizer contribution to your super fund?
Well, he was 64, wasn't he?
Yeah, she's 59. Yes.
His name's ours.
We don't know.
How long of that is there?
Yes.
There's a lot to unpack with, are they even eligible for the downsize contribution?
And that's the thing. Sounds like the advisor lied. Yeah, that $2,000 a year is rubbish.
No, I think the advisor was very honest, whether they understood what he was talking about, whether there was an upfront fee for a statement of advice plus a retainer, an annual retainer, and $2,000 to $3,000 as an annual retainer isn't out of the ballpark.
For that kind of work, I would consider that very reasonable.
And probably the value add info.
And I don't understand, how can you pull your super out? This requires extenuating circumstances. Like, at what point are people giving, oh yes, your husband can do that next year? Well, we don't know how much is in the husband's. We don't know. Like, it's just,
Yes, at 65, he can. That's not an extenuating circumstance. That's just a release.
correct. And actually, we don't know who has the money in the super fund. Like, if it's her money in her super fund at 59, well,
No, she can't.
well, if she retires completely.
After 60.
So there's just so many different possible outcomes.
And so many dodgy answers.
Exactly. Like the one, I'm about to do a financial planning course in July. Give me 6 weeks and I should be able to help you.
Be still my master's degree. Ouch. Can you still evaluate financial planning courses?
No. Well, surely not.
You can, but you wouldn't be a licensed financial advisor.
No, well, if you're doing training now, you have to do a professional year. So
Let's go into what's current.
okay, for our last little session of the day, what's current?
Education requirements. Let's go there.
What education do you have?
Master's degree and specialist accreditations in self-managed superannuation and aged care.
Yep. So over this side, master's degree, specialist accreditation in superannuation and derivatives. So
How long did that take you? A little more than 6 weeks?
a little more than 6 weeks.
I think it took me 9 years to do my diploma of financial services, my advanced diploma of financial services, and my master's degree.
I think when I started, they didn't even exist. So I did a Bachelor of Business Accounting, then a graduate diploma in applied finance, and then started doing DFPs, Diploma of Financial Planner 1 to 8.
Yep, and the advanced diploma.
That was in 1998.
How many hours annually do you do in ongoing learning and continuing?
60.
Yeah, my 60 to 90 every year.
Yep. Well, 60 is my minimum. Like 60 is my mandated, as would yours be, because we both have our own licenses.
So responsible managed duties.
Yep.
Additional for our accreditations in super and, for me, aged care. So there's so many hours of those, along with the government mandated 40.
Yes. So the idea that give me 6 weeks, like politely, bollocks. Can I just say politely, fuck off? Like, you actually have to have a university degree now, and this is to do financial planning.
I mean, so since the Royal Commission, and it was funny, the industry's been going this way to become a profession for over 20 years. So the reason I did my master's degree in the 2000s was because they were talking about one day every advisor will need a degree.
Yep.
And it is exactly what happened.
Yep.
10 years later.
But it is,
in 2000.
if you want to be really good at what you do, you have to do the study anyway, because it always changes. And the thing, now this is what really gets my goat, is people that hold themselves out to be educated or even a financial planner who are not. We might have to do that on the next session though, because that's a rabbit hole right there waiting to happen.
And thankful raffles.
Well, they fall into that, don't they?
Yeah, they do.
So tell me, next cocktail, what do we need? Don't give it away this time.
Midori. What?
Vodka.
Got pineapple juice and cream. Let's see what we can come up with that.
Make sure that you are all set to go. Join us for cocktails and finance on the couch.
Hi, I am Amanda, and thank you so much for tuning in to an episode of Two Drunk Planners. We've loved having you join us, and if you liked being there, please remember to like and subscribe.
Don't forget though, no substitute for good advice. What we've talked about today doesn't take into account your situation at all. If you do want advice, check us out on our website, twodrunkplanners.com.au, or if you're looking for an advisor, hop onto the FAAA site and find an advisor there.
And if you've got any questions you'd like to throw at us, please don't hesitate to reach out. We'd love to unpack them on the couch as well.
Until then, catch you next time.
Bye.